Welcome once again to the BookMind channel. We're the place where we do these deep dive conversations on famous English books, really digging into the core wisdom and trying to make it actionable for you.
It's great to be here. Today, we're tackling something really special, I think. It's a deep dive into a text that, well, it really should be essential reading for anyone managing money or even just trying to get a handle on business basics.
That's right.
It's the Essays of Warren Buffett, Lessons for Corporate America. This collection, put together and edited by Lawrence A. Cunningham. It's just fantastic, a real masterclass.
Yeah, it really is. And we're not looking at, a standard biography or some dry textbook. This compilation gathers decades of Warren Buffett's annual letters to Berkshire Hathaway shareholders. So our mission today, really, is to treat this collection as the ultimate shortcut. It's like a direct line, completely unfiltered, into the thinking of one of the world's most successful investors. We're talking investment philosophy, ethical standards, how he thinks about accounting, taxes, the whole package.
Absolutely. And, for many of you listening, you might be aware of the financial world, maybe you follow it a bit, but actually feeling well-informed can seem, well, complicated, intimidating even.
Right.
But Buffett, especially through Cunningham's really smart arrangement of these essays, he makes these complex ideas feel, dare I say, accessible, even enjoyable.
He does have a way with words.
He does. So by the end of this deep dive, our goal is simple: to give you actionable knowledge, the kind of confidence you need to approach investing thoughtfully, turning what might seem confusing into, hopefully, a real opportunity.
Okay, let's get into it. Section 1 seems like the right place to start: Buffett's ideas on governance and ethics. Specifically, why he can't stand corporate theatrics and insists on, well, total honesty for management. So I found his take on the typical corporate shareholder meeting really quite cutting. He basically says most of these annual gatherings are a waste of breath, right? Serving almost no real purpose for a serious investor. Why such a harsh view on what's often seen as, a pillar of shareholder democracy?
Well, his criticism really comes down to productivity, or the lack thereof. He sees these meetings as fundamentally unproductive. Often, they feel designed more to avoid real financial clarity than to actually achieve it. In his experience, most big corporate meetings are just surface level. You get carefully scripted statements, management trying their best to dodge any tough questions, and sometimes shareholders who seem more interested in, say, complaining about minor office details than digging into the actual health of the business.
So the main point of the meeting, discussing financial performance, openly gets lost in the noise.
That's exactly it. And what happens? The serious investors, the ones with significant stakes who genuinely care about the returns and the strategy, they just stop showing up.
Yeah, you can see why.
They realize the conversation inevitably drifts away from meaningful financial talk into, personal gripes or even politics. And this lack of real tough engagement, it lets management off the hook. They can avoid facing specific scrutiny about how they're allocating capital or why certain operations might be failing.
Okay, that definitely sets up the contrast with the Berkshire Hathaway annual meeting. People call it Woodstock for capitalists, which sounds intense. It seems like they've deliberately built something completely different, focused on genuine dialogue.
They absolutely have. And the Berkshire difference, it's built on just unwavering honesty and accessibility. Buffett, as CEO, and Charlie Munger, the vice chairman, they commit to answering every single question shareholders ask, no matter how long it takes.
Every single one.
Every single one. It's like an endurance test, but it's rooted in this core principle of complete clarity. They want to give shareholders useful, accurate, totally unvarnished information because they live by the golden rule of business, essentially. They expect the same transparency from others that they provide themselves.
Right.
If Buffett were just a shareholder in some company, he'd demand total clarity.
Yeah.
So he makes sure his own shareholders get exactly that.
And this idea of clarity, it flows right into his warnings about certain accounting practices. What are the big red flags he tells investors to watch out for when they're looking at financial reports?
The biggest red flag, bar none, is ambiguity. If the accounting seems unclear or deliberately vague or just overly complex, that should immediately make you suspicious.
Why is that?
Well, it's just one of two things, usually. Either management is actively trying to hide something, maybe poor performance, maybe excess debt, or almost as bad, they might not even understand their own financial situation properly. Buffett often says that truly outstanding performance shouldn't need complex explanations. If the way they present their financials isn't clear and sound, you should proceed with extreme caution as an investor.
And it's not just about the big numbers on the first page, is it? He specifically warns people to dig into the fine print, those dense footnotes you often find buried at the back of reports.
Oh, absolutely. Those footnotes.
Yeah.
That's often where the really critical, sometimes hidden information lives. If those notes are incredibly hard to understand, full of jargon that feels like you need a PhD to decode it, that's a major warning sign.
Because it might be deliberate obfuscation.
It often signals exactly that. A deliberate attempt by management to obscure things like liabilities, maybe capitalize expenses in a questionable way, or hide debt off the balance sheet. Look, a report might technically follow all the rules, generally accepted accounting principles, or GAAP, but that compliance doesn't automatically mean it's honest.
Right.
The key question you have to ask is management trying to reveal the truth here, or are they trying to conceal it?
And this concealment often ties into what he calls the illusion of strength, doesn't it? Where companies kind of cherry pick the good news and filter out anything that might look bad.
Precisely. You see this a lot in reports that heavily promote metrics like, say, EBITDA earnings before interest, taxes, depreciation, and amortization.
Right, that one comes up a lot.
It does, but notice what's missing. Depreciation. Depreciation is a very real economic cost. Machines wear out, buildings degrade. It costs money to maintain or replace them. By focusing on EBITDA instead of true net earnings, management can create this illusion of higher profitability than what's actually sustainable. They're basically showing you the data that paints the rosiest picture, even if it ignores some very real costs of staying in business.
That illusion feels particularly dangerous when CEOs start making guarantees about future returns.
Yeah.
Buffett seems really wary of that.
Oh, intensely wary. Predicting wildly optimistic growth, like promising, say, 15% annual growth forever, is, in Buffett's view, fundamentally misleading.
Yeah.
Investing always involves risk. It's inherent. No CEO, no matter how smart, can guarantee specific future returns in a world that's constantly changing. When a CEO speaks with that kind of absolute certainty, it's usually not a sign of confidence or competence. It's often a sign of either deception or, frankly, a deep misunderstanding of how economies actually work. You should meet those promises with instant skepticism.
And this links right into his critique of corporate standards, or maybe the lack thereof, for CEOs specifically. He points out that most jobs have clear ways to measure performance, but for the person at the very top, those standards often seem to vanish.
This is a really fundamental criticism he has of modern corporate governance. Think about it. In most roles within a company, performance is fairly easy to quantify, right? Sales targets, production quotas, project deadlines.
Sure.
But when you get to the executive suite, suddenly the benchmarks can become vague, subjective.
Right.
Sometimes they barely exist at all. And this lack of clear accountability is a huge problem. It allows people who might be, say, politically skilled or well-connected, but maybe not great at actually allocating capital wisely, to run huge corporations.
And stay there too long.
And stay there much longer than their actual performance would justify. The system often lacks the tough self-correction mechanisms you see at lower levels.
He also brings up an interesting ethical point about corporate charity. He notes that roughly half of all charitable giving by corporations is decided by the directors, without really checking in with the shareholders, the people who actually own the money being given away.
Yeah, he sees this as a potential misuse of the owner's capital. His perspective is pretty straightforward, that money belongs to the shareholders. He frames it with a question. How would a director feel if the company's owners just arbitrarily decided where the director's personal salary should be donated?
Good point.
He believes corporate donations should ideally align with the company's actual business interests first. Any giving beyond that, any purely philanthropic stuff, should really reflect shareholder preferences, not just the personal priorities of the CEO or the board members.
Okay, finally, let's get to what feels like the absolute bedrock of his ethical framework: risk management. He seems completely uncompromising on this point.
Utterly uncompromising. He states it very clearly. Controlling risk is the CEO's personal responsibility. Full stop. If a CEO isn't willing to take direct ownership of identifying, managing, and mitigating risks, then they are fundamentally not qualified for the job.
Wow.
And this whole stance is driven by that famous guiding principle, one that honestly every leader should probably have taped to their desk. We can afford to lose money, but we can't afford to lose our reputation.
That reputation over profit idea seems to shape everything they do.
It really does. Look, Berkshire is massive. They employ, over 250,000 people across tons of different industries. Buffett's a realist. He knows mistakes will happen. Perfect behavior across that many people is impossible.
Sure.
But the crucial thing, the non-negotiable part, is the response. When a problem comes to light, the leadership has to act immediately and decisively. No hesitation, no trying to hide it, no downplaying something that could damage the firm's integrity. The principle demands transparency and swift correction, even if it causes some short-term financial pain.
That sets an incredibly high ethical bar, one that maybe few public companies consistently meet.
It really does. It requires a truly long-term perspective, one that fundamentally rejects short-term financial tricks in favor of building and maintaining enduring trust.
Okay, shifting from ethics to actual investment strategy. The absolute foundation of Buffett's philosophy seems remarkably simple on the surface. Focus on the business itself, tune out the market noise. He famously says he's a business analyst, not a market analyst.
Yeah, and that distinction is it's everything. When Buffett buys stocks for Berkshire, the decision hinges entirely on the company's long-term economic prospects. What's its real earning power? Does it have a durable competitive advantage, a moat? Is the management good and trustworthy?
Right.
He explicitly tells you over and over he's not interested in trying to predict where the market's going next week or next month. He doesn't worry about daily stock price blips. He doesn't panic if there's a short-term loss on paper. Because if the underlying business is fundamentally sound, he believes the market price will eventually catch up to reflect its true value. His whole focus is on acquiring ownership stakes in great companies.
And this whole idea is perfectly captured in that famous metaphor from his mentor, Ben Graham, Mr. Market. It might be the single most brilliant concept ever devised for explaining market irrationality to everyday people.
Oh, Mr. Market is pure genius. Graham personified the market as this fictional business partner you have. Every single day, Mr. Market shows up at your door. He offers to either buy your share of the business or sell you his share, and every day he quotes a different price.
Okay.
But here's the twist. Mr. Market has, let's say, serious emotional problems. Some days, he's euphoric, incredibly optimistic, and he'll quote you a ridiculously high price for the business. Other days, he's deeply depressed, maybe panicked by some bad news headline, and he'll offer to sell you his share for pennies on the dollar, a price that drastically undervalues the actual business.
So the power for the investor comes from recognizing his moods and not getting swept up in them.
Exactly. The key is emotional discipline. You don't treat Mr. Market like some kind of all-knowing guide to value. You treat him like an obliging, if erratic, partner who's always willing to come back tomorrow with a new price, no matter how you treated him today.
So you ignore him when he's crazy high.
Right. When Mr. Market is greedy and asking for too much, you just ignore him, politely decline. But when he's depressed, panicked, and offering to sell you a piece of a fundamentally sound business for way less than it's worth, that is your opportunity. The investor's job is simply to spot the difference between the price, which is Mr. Market's emotional quote, and the underlying value, the actual economic worth.
He uses such a great kind of counterintuitive analogy to explain why short-term traders get excited when prices go up, something he finds illogical for a real investor. The hamburger analogy, can you walk us through that?
Yeah, it perfectly illustrates the long-term acquisition mindset. Think about it. If you absolutely love hamburgers and you plan on eating hamburgers regularly for the rest of your life, would you prefer the price of ground beef to go up or down?
Down, obviously, so I can buy more hamburgers for the same money.
Precisely. Buffett applies that exact same logic to stocks. If you are a long-term investor, someone who plans to keep investing for decades, you should actually prefer sinking prices for the stocks of great companies you want to own more of.
Because lower prices let you buy more shares, more future earning power for less money.
Exactly. So when a stock that a true long-term investor loves hits a new all-time high, Buffett isn't cheering. He's actually a little bit annoyed.
Annoyed? Why?
Because it means that any future money he invests in that company will now buy him less ownership, less of that excellent business. It completely flips the script on typical investor psychology, which is why it's such a powerful mental model.
It really is a radical shift from the typical trading mentality, isn't it?
Absolutely. Traders are happy when prices soar because they're looking to sell quickly for a profit. Buffett, though, sees himself as a buyer, an accumulator of businesses. He wants to acquire them at a discount, letting that compounding power work over decades. He understands that high prices today inherently mean lower future returns.
Okay, but what happens if the market gets really frothy? What if everything seems expensive and those great, undervalued, long-term opportunities just aren't there? The source mentions he sometimes turns to arbitrage in those situations. What's that about?
Arbitrage is a different kind of strategy. It's about exploiting temporary, almost guaranteed price discrepancies, usually in announced deals or specific situations. It's something he might do when good long-term investments are scarce, as a way to park capital safely and earn a small, predictable return.
Can you give an example?
Sure.
Yeah.
Let's say Company A announces it's going to buy Company B for exactly $100 per share in cash, and the deal is very likely to go through. But right now, Company B's stock is trading on the market for only $98. Buffett might step in and buy shares of Company B at $98. His goal isn't based on Company B's future prospects. It's simply to collect that $2 difference when the deal officially closes and he gets paid the $100.
So it's not about long-term growth at all. It's about capturing a small, defined profit from a specific short-term event that's already been announced.
Exactly. It's based on the certainty or near certainty of a contractual outcome. Now, you still have to do your homework. You need to be confident the deal won't fall apart for some reason, because if it does, that $2 spread could vanish or even turn into a loss.
Right.
But generally, the profit margin in arbitrage is smaller, but much more reliable and lower risk than general stock market investing. It's a conservative way to keep capital working when those wonderful fat pitches, great businesses at cheap prices aren't available.
Let's shift now to something that really goes against the grain of conventional financial advice. Diversification. It's like the first rule you learn, right? Don't put all your eggs in one basket. But Buffett seems to advise against diversifying just for the sake of it.
Yeah, he's famously skeptical of what he calls diversification. His philosophy revolves heavily around the idea of the circle of competence, meaning you should stick to investing only in businesses you genuinely understand, inside and out, their economics, their competitive position, the quality of their management. If you can truly understand, say, 5 or 10 businesses deeply, then his advice is actually to concentrate your investments in those best ideas.
Concentrate. That sounds risky for most people.
Well, he argues that widespread diversification is often just a cover for ignorance. If you spread your money thinly across 50 different companies, the odds are you don't really know enough about any single one of them to have a strong conviction. For him, diversification becomes this kind of refuge for investors who haven't done the hard work of actually figuring out which businesses are truly exceptional.
But isn't concentration incredibly risky if you happen to be wrong about one of your few picks? Does he acknowledge that his approach, which requires really deep research, might not be practical for the average person who isn't doing this full-time?
He does, absolutely, though maybe indirectly. While he advocates concentration for those who can do the work and develop genuine expertise, his advice for the vast majority of people, those who can't dedicate the necessary time and effort to in-depth business analysis, is quite different.
What's his advice for them?
For most people, he actually recommends simply investing in a low-cost, broad market index fund, like an S&P 500 tracker. That way, you automatically achieve massive diversification, you benefit from the overall long-term growth of the economy, and you don't have to worry about picking individual winners or losers.
Okay, that makes sense. Concentration for the experts who've done the homework, index funds for everyone else.
Pretty much. But if your goal is to actually beat the market averages over time, he believes that focused, concentrated approach is the only way to do it.
And related to risk, he also seems quite dismissive of beta. That's the standard metric finance uses to measure a stock's volatility or risk compared to the market, right? Why doesn't he put much stock in that?
He dismisses beta because he fundamentally disagrees with its definition of risk. Beta just measures historical price volatility, how much a stock price has bounced around relative to the overall market. A beta of 1.5 suggests it's been 50% more volatile than the market average. But Buffett argues that true investment risk isn't just volatility. Volatility is temporary ups and downs. True risk, for him, is the risk of a permanent loss of capital.
Can you explain that difference?
Sure. A really wonderful, stable business might suddenly face a disruptive competitor or a technological shift that permanently damages its earning power. Its historical beta might have been very low, suggesting low risk, but you could still suffer a permanent loss if the business itself deteriorates.
Okay.
Conversely, a stock might be very volatile in price. Maybe it's in an unpopular industry or had some temporary bad news, so its beta is high. But if you bought it when it was incredibly cheap, far below its intrinsic value, your actual risk of suffering a permanent loss might be very low because you have that huge margin of safety.
So focusing on beta is kind of a distraction. It stops you from doing the real work of figuring out the company's actual value and whether management is trustworthy, regardless of how jumpy the stock price has been lately.
That's precisely his point. The goal isn't just to find stocks with the low betas. The goal is to find wonderful businesses, run by people you trust, and buy them at sensible prices. Relying heavily on a simple statistic like beta is, in his view, often a case of academics substituting mathematical formulas for the much harder but necessary work of fundamental business analysis.
Okay, this next part is really useful, I think. Buffett simplifies the whole investment world down into just three main categories. Let's start with category one. Currency-based investments. These are the ones people often think of as the safest options, right?
That's right. This category includes things like bonds, mortgages, CDs, bank deposits, basically anything where the payout is denominated in a fixed amount of currency, like dollars or euros. And yes, they are often perceived as safe because typically you don't lose the nominal amount you put in. You buy a $1,000 bond, you usually get $1,000 back at maturity.
But Buffett argues this perception of safety is flawed, potentially dangerously so.
Exactly. The risk here isn't losing the face value of your investment. The real insidious risk is the erosion of your purchasing power over time, thanks to inflation.
Ah, inflation, the silent wealth killer.
Precisely. Governments print money, and over time, each dollar tends to buy less. If inflation is running at, say, 3% a year, and your safe bond is only yielding 2%, you are guaranteed to lose 1% of your real wealth, your actual buying power, every single year. So Buffett tends to avoid these kinds of investments, especially during periods when inflation is expected to be significant. They rarely build wealth. They mostly just try to preserve the nominal value, but often fail to preserve the real value after inflation and taxes.
Okay, that's category one. Then we get to category two, non-income producing assets. This is where he famously puts gold, which always seems to stir up passionate debate among investors.
Yeah, category two is all about assets that generate absolutely zero income. No cash flow, no dividends, no rent, no output. You buy them purely on the hope, the speculation, that someone else, the proverbial greater fool, will come along later and pay you an even higher price for it.
And gold is the classic example.
It's the textbook example. Gold just sits there, doesn't produce anything. In fact, it costs you money to store it safely and insure it. It doesn't grow corn, it doesn't manufacture goods, it doesn't generate rental income. Its value is driven almost entirely by supply and demand dynamics based on fear, speculation, jewelry, and some industrial use.
So he basically strips away all the historical mystique and just looks at it cold. It's a barren asset. It doesn't do anything productive.
That's his core argument. To Buffett, this complete lack of productive substance makes it an inherently inferior long-term investment compared to assets that actually generate wealth. With gold, you are entirely dependent on finding that future buyer who is even more optimistic or fearful than you are. You're not relying on the asset's own ability to grow and compound earnings over time, which is his definition of real wealth creation.
Which brings us neatly to his favorite category, category three, productive assets.
This is where the magic happens, according to Buffett. This is where enduring wealth is truly created. We're talking about owning businesses, whether directly or through stocks. We're talking about farms that produce crops or real estate that generates rental income. Assets that actively do something, generate income, produce goods or services, and hopefully expand their value over time.
And why are these superior?
Because they have the potential to generate strong, compounding returns over the long haul. They often require relatively modest amounts of ongoing capital investment compared to the wealth they can generate. And historically, over long periods, productive assets like businesses have significantly outperformed the other two categories. They actively increase your purchasing power because they generate cash flow that can be reinvested to generate even more cash flow. It's the engine of capitalism, really.
Makes sense. But despite that clear preference for tangible, productive assets, a lot of people still get drawn towards really high-risk stuff like junk bonds. Why do those exist?
Junk bonds are a perfect example of how high potential returns often mask extremely high risk. They are essentially loans made to companies or entities that have very poor credit ratings, meaning they have a history or a high probability of not being able to pay back their debts.
So why would anyone lend them money?
To entice investors to take on that huge risk, junk bonds have to offer much higher interest rates than safer bonds. They became really popular in the 1980s, partly fueled by deregulation and the rise of leveraged buyouts, where acquirers needed risky financing. But the high interest rate is just compensation for the significant chance that you might lose some, or even all, of your original investment. People drawn to the allure of those high yields often end up experiencing substantial losses. It really proves the old adage. There's no free lunch. High yield generally means high risk.
It's a good reminder, though, that even the absolute best investors make mistakes. Buffett is refreshingly open about his own errors. Tell us about his adventure in the airline industry. I think there's a famous Richard Branson joke related to this.
Yes, Branson's quip perfectly sums up the brutal economics of the airline business. He joked, "How do you become a millionaire? Start out as a billionaire and then buy an airline." The point is, the airline industry is just notoriously difficult. It's a relentless destroyer of capital. Buffett admitted he once invested in an airline, U.S. Airways, I believe it was. On paper, maybe the reports looked okay in isolation at that moment, but he confessed he overlooked the absolutely brutal, overarching economics of the industry itself.
What makes it so tough?
Airlines face a killer combination of problems. They require massive amounts of capital for planes. They have high fixed costs, fuel, labor, maintenance. They often deal with powerful unions, and the competition is absolutely ferocious. Price wars are common. This means even small dips in demand or rises in fuel costs can instantly wipe out profit margins, leading to huge losses very quickly.
But that painful experience actually helped solidify one of his most powerful pieces of advice, didn't it? About managing emotions in the market.
It absolutely did. It reinforced that timeless piece of wisdom. Be fearful when others are greedy, and be greedy only when others are fearful.
Do you unpack that a bit?
Sure. When the market is euphoric, when everyone is piling in driven by sheer optimism and stock prices seem detached from reality, that's when you need to step back and be fearful. Fearful of overpaying, fearful of getting caught up in the mania.
And the flip side.
The flip side is when there's blood in the streets, metaphorically speaking, when others are panicked, terrified to invest, selling indiscriminately, and fundamentally sound businesses get dragged down to bargain prices, that is the moment to be intellectually greedy, to have the courage to buy when everyone else is selling. It takes immense emotional discipline to buy when things look scary, and just as much discipline to resist buying or even sell when everything looks absolutely perfect.
Okay, let's tackle a really interesting, complex problem Buffett discusses. He observes that while U.S. businesses overall seem to be doing really well, hitting record profits sometimes, many individual investors feel like their own returns aren't keeping up. This leads him to this brilliant analogy about the leakage of wealth.
Yes, this analogy is so important for understanding the cost structure of modern finance. He asks you to imagine a single wealthy family that, through inheritance, owns every single successful corporation in America. They should be incredibly rich from all the profits these businesses generate, right?
Logically, yes.
But then, over time, this family starts outsourcing the management of these businesses, not just hiring internal managers, but bringing in layers of expensive external helpers, consultants, advisors, money managers, maybe private equity firms or hedge funds.
Okay, I see where this is going.
This is the leakage. The underlying businesses themselves might still be performing brilliantly, generating huge profits, but the family's actual take-home return, their net wealth increase, starts to shrink over time. Why? Because a significant chunk of those corporate profits is being siphoned off to pay the fees and costs of all these intermediaries, these managers and advisors.
And he draws a direct parallel between this imaginary family and what happens when everyday investors entrust their money to high-fee investment structures, like hedge funds or actively managed mutual funds.
Absolutely. That's the core point. The average investor effectively hands over their piece of those productive Category 3 assets to professional managers. And these managers charge substantial fees. The classic 2 and 20 model is common in hedge funds, meaning a 2% annual management fee on the assets plus 20% of any profits earned.
Wow, that adds up.
It adds up enormously over time. So even if the underlying companies owned by the fund are performing fantastically well, the end investor is forced to settle for significantly lower net returns because so much of the gain is flowing out through these fees and costs paid to the managers. This friction, this cost of outsourced management, is a primary reason why great corporate performance in the economy doesn't always translate into equally great returns in your brokerage account. It's a pretty direct criticism of the high-cost financial services industry.
All right, let's talk about mergers and acquisitions, M&A. Buying high-quality businesses seems to be a core part of Berkshire's DNA, almost a favorite activity. Buffett even compares hunting for a good acquisition to searching for a spouse, stressing patience and commitment.
It's a very apt, very human analogy for what can seem like a cold financial process. Just like rushing into marriage often leads to regrets, rushing into a major business acquisition, maybe because you feel pressure to do a deal, any deal often leads to poor long-term results. Buffett openly admits he made mistakes early in his career. Buying companies based more on, say, cheap statistics or surface-level appeal rather than doing the deep dive into their fundamental economics and management quality. Finding the right acquisition, one that truly fits and adds long-term value, requires patience. It requires genuine interest in the business itself, not just the deal. And it requires ensuring there's a good fit in terms of management philosophy and long-term stewardship.
And once he does decide to acquire a company, the absolute guiding principle seems to be intrinsic value, especially when it comes to using Berkshire Hathaway's own stock to pay for the deal. He has a really strict rule about that, doesn't he?
Oh, incredibly strict. It's basically non-negotiable. He will only issue Berkshire shares to pay for an acquisition if the company or assets he's getting in return are worth at least as much, in terms of true intrinsic value, as the Berkshire shares he is giving up. Ideally, he wants what he's getting to be worth more.
And the logic is simple.
The logic is fundamental shareholder protection. He asks that basic question. Why would you ever trade something worth $5 for something worth only $5 or worse, $4? Issuing new shares dilutes the ownership stake of all the existing Berkshire shareholders. Unless the assets being acquired genuinely add more value than the cost of that dilution, the existing owners are actually being made slightly poorer by the deal. It's a powerful defense against doing deals just for the sake of getting bigger.
This cautious approach sounds like he'd be particularly wary of leveraged buyouts, or LBOs, those deals often financed with huge amounts of debt. He uses an interesting analogy about a lame horse to warn investors about sellers in these situations.
Yeah, the lame horse analogy is great. It warns about sellers who try to offload a company while it's still walking fine, meaning they might be trying to sell it quickly before deeper underlying problems become obvious to the buyer.
Covering up issues.
Exactly. And LBOs can be especially risky territory for this. In a typical LBO, the company being acquired is saddled with the massive debt used to finance its own purchase. The new owners, often private equity firms, might then be forced to focus intensely on short-term cash flow just to make the huge interest payments.
Which could hurt the long term.
It often does. They might slash crucial long-term investments like research and development or cut corners on maintenance just to meet those debt obligations. Buffett generally steers clear of these highly leveraged situations. He much prefers acquiring businesses that were built carefully over time, often by their founders or families, and ideally where the existing management wants to stay on and continue running the business post-acquisition. He's looking for continuity and stewardship, not just a quick financial flip.
Okay, this focus on true worth makes it critical that we really understand the difference between intrinsic value and book value. These terms get thrown around a lot. How exactly does Buffett define intrinsic value?
Intrinsic value is really the holy grail concept for him. It's the estimated underlying worth of a business. You calculate it by projecting all the cash the business can be expected to generate from its operations from today until Judgment Day, basically.
All future cash flows.
All the future cash flows you reasonably expect it to produce. And then, this is the crucial part, you discount those future cash flows back to what they're worth in today's money. Because a dollar tomorrow is worth less than a dollar today.
Right, the time value of money.
Exactly. Now, it's important to stress, intrinsic value is an estimate. It's not a precise, hard number you can find on a balance sheet. But, Buffett argues, it's the most important number. And two reasonably informed investors, looking at the same business and the same facts, should arrive at estimates that are roughly in the same ballpark. It represents the true economic reality of the business's earning power, independent of short-term market sentiment.
Okay, so if intrinsic value is the most important number, why doesn't Berkshire just calculate it and put it in their annual report? Instead, they seem to provide the raw data and let shareholders figure it out themselves. That seems counterintuitive.
It does seem a bit strange at first, but it's actually a combination of intellectual honesty and transparency. They do report book value per share in their reports. That's the accounting number, basically. Total assets minus debt and liabilities divided by the number of shares.
But he says book value isn't very useful.
He consistently says book value has limited usefulness and often differs significantly from true intrinsic value. Why? Because book value is based on historical costs recorded under accounting rules. It doesn't necessarily reflect the current economic earning power or the real market value of assets.
Ah, okay.
So, by providing shareholders with the raw financial data, the earnings, the assets, the liabilities, the cash flows, Berkshire's essentially saying, look, book value is what the accountants make us report. But here are the real facts about the business. We trust you, our partners, to use this data to make your own informed estimate of the intrinsic value. He stresses that determining real value requires looking at current earnings and, crucially, making realistic projections about how those earnings can grow over the long term. The future direction is paramount.
We touched on complex financial models earlier. He specifically mentions the Black-Scholes model, which is widely used to price stock options. Interestingly, Buffett and Munger include Black-Scholes calculations in their reports, even while admitting the model produces strange results over long periods. Why include something they think is flawed?
This is a really fascinating example of Buffett being pragmatic, navigating the realities of the financial world. The Black-Scholes model is the industry standard for option pricing. It's taught in every business school, it's used by regulators, it's embedded in financial software everywhere, it calculates a theoretical fair price based heavily on factors like volatility.
But Buffett doesn't think volatility equals risk.
Exactly. He and Munger know the model is conceptually flawed for long-term investors because it equates risk with price volatility, which they see as just noise. Black-Scholes doesn't properly account for the real risk, like the possibility of a company going bankrupt, which would make the option worthless regardless of past volatility.
So why include it?
They include it because not including it would likely raise more questions than it answers. Omitting a standard, widely accepted model, even when they disagree with fundamentally, could make Berkshire look like it's not being transparent or that it's trying to hide something according to conventional metrics. So they include the Black-Scholes calculation, essentially complying with financial orthodoxy, while simultaneously telling their shareholders in the text of the report why they think the model has significant limitations.
So it's like a nod to the standard practice, even while explaining why they think the standard practice isn't perfect.
Precisely. They show you the number the model spits out, but then they educate you on why you shouldn't rely on it as the sole measure of value or risk. It's a masterclass in transparency, really.
Okay, this section feels like where Buffett really pulls back the curtain on how companies can, well, mislead investors while staying technically within the legal lines of accounting rules. He starts by saying every investor needs to ask 3 key questions, no matter if a company's reports follow GAAP or not.
Yeah, these 3 questions are like the ultimate reality check, cutting through any accounting fog. They are: 1, what is the true underlying economic value of this business? Forget the accounting number for a second. What's it really worth?
Okay.
2, can this business realistically meet all its future obligations? Not just paying the bills next week, but covering its long-term debts, pension promises, everything.
On the 3rd.
3, how competent and, crucially, how trustworthy is the management team running the show? Because even a great business can be ruined by inept or dishonest managers. Buffett warns constantly that GAAP, generally accepted accounting principles, provides a framework for standardization, which is useful, but it is absolutely not a guarantee of truth or accuracy. Companies can, and often do, use the flexibility within GAAP rules to manipulate figures, making things look better than they really are, all while appearing perfectly legitimate on the surface.
What's a common way they might manipulate a number that investors watch closely, like net income?
A really widespread technique involves how companies manage realized versus unrealized gains and losses. Net income, the bottom line profit number everyone focuses on, can be legally managed in several ways. For example, standard accounting usually includes realized profits in net income. That's cash you actually got from selling an asset for more than you paid.
Right.
But it often excludes unrealized gains profits that exist only on paper because an asset you still hold has gone up in value, but you haven't sold it yet. By carefully choosing when to sell certain assets that have gone up or down in value, management can effectively smooth or shape the reported net income figure from quarter to quarter.
So they can make earnings look less volatile or hit analyst targets?
Exactly. They can make performance look steadier than it really is or ensure they meet market expectations, even if the core operating business isn't actually doing that well. Buffett points out that Berkshire could easily play these games with its huge investment portfolio, but they deliberately choose not to. He explicitly warns shareholders, though, that many other corporations do engage in this kind of earnings management.
And then there's the trick he calls the restructuring charge illusion. That sounds like using a one-time event to kind of wipe the slate clean of past errors.
That's precisely what it often is. Officially, a restructuring charge is supposed to represent the costs associated with the specific major overhaul of the business, closing factories, laying off workers, things like that. It's meant to be a one-off event.
But it gets abused.
Frequently, it can become a convenient big bath accounting moment. Management takes all sorts of accumulated losses and past mistakes, maybe inventory that isn't selling, failed projects they should have written off years ago, assets that are clearly overvalued on the books, and they lump them all together, blaming them on this single restructuring.
What's the effect of that?
It allows them to get all the bad news out in one go, often buried under the one-time restructuring label. This cleans up the balance sheet and makes future performance look much better by comparison, because you've essentially flushed years of accumulated problems down the drain in a single reporting period. It hides the reality of potentially years of poor underlying performance.
The golfer analogy he uses here is just perfect for explaining the psychology behind this, isn't it?
It's brilliant. Imagine a golfer who's known for usually shooting respectable scores, say in the high 80s. But secretly, his game has been getting inconsistent, maybe with some really terrible rounds mixed in. One week, he comes in with an absolutely disastrous score, like a 140. But he doesn't just admit he played terribly. He announces he's undertaken a major swing restructuring. Then the following weeks, he goes back to shooting his normal average scores, maybe 91, 94, 89.
So compared to the 140, it looks like a huge improvement.
Exactly. To an outsider just looking at the recent trend, it looks like he had one terrible anomaly restructured and is now showing steady, solid improvement. But in reality, he just used that one catastrophic score to mask the underlying mediocrity or inconsistency that was already there. He's created an illusion of recovery and stability. That's what companies can do with restructuring charges.
The source does mention that accounting rulemakers, like the FASB, Financial Accounting Standards Board, have tried to crack down on some of these maneuvers, especially around how companies account for acquisitions.
Yes, they have made efforts. FASB famously banned the pooling of interests method for accounting for mergers. That method was notorious because it allowed the acquiring company to record the assets of the company it bought at their old, often much lower, historical book value.
Why was that bad?
Because it made the acquirer's future earnings look artificially high. If you buy assets cheaply on paper, then any income they generate looks like a fantastic return on that low recorded asset base. FASB mandated the use of purchase accounting instead. This requires the acquirer to record the assets they buy at their current fair market value at the time of the deal.
So it reflects the true cost.
Yes, it ensures the real economic cost of the acquisition is reflected on the balance sheet from day one, making it much harder to artificially inflate future profitability through accounting tricks.
Our regulations have also pushed for more detailed reporting in general.
Absolutely. Newer GAAP rules require companies, especially large conglomerates like Berkshire, to disclose much more detailed financial information about their various operating segments or subsidiaries. You have to break out things like revenue, profit, assets, and even specific liabilities like tax obligations or future pension responsibilities for each significant part of the business.
Preventing them from hiding problems in big aggregate numbers.
Precisely. It prevents companies from burying problems in one poorly performing division by blending its results with stronger divisions under one vague, consolidated number. More detail generally means more transparency.
Okay, let's shift gears slightly to taxes. Buffett spends quite a bit of time discussing the impact of tax law changes, particularly the Big Tax Reform Act of 1986. He notes that, maybe surprisingly, it ended up being somewhat negative overall for Berkshire shareholders.
Yes, that's a key point. While the 1986 Act did lower the top corporate income tax rate significantly, from 46% down to 34%, other changes actually ended up hurting Berkshire's shareholders' net returns. The main hit came from changes to how capital gains were taxed, both at the corporate and individual level.
How did it impact the shareholder return directly?
Before the act, Buffett calculated that every dollar Berkshire earned translated into about 80 cents of market value increase for the shareholder after all taxes were considered. After the reform, that dropped to only about 72 cents. This was largely because the tax rate on the shareholders' eventual capital gains when they sold their stock effectively went up, and also because taxes on the gains Berkshire itself realized within the company also changed. Even though the headline corporate rate went down, the total tax bite on the full cycle of earning and distributing wealth increased.
That leads to his really interesting question about corporate taxes. When the government lowers the corporate tax rate, who actually benefits? Does the company pass the savings to customers via lower prices, or does it just flow to the owners as higher profits? His answer seems to depend on the type of business.
Exactly. His analysis is very insightful here. He says it depends on two main factors.
Yeah.
How much pricing power the business has and whether or not it operates in a regulated industry.
Okay, let's take regulated industries first.
If a business is heavily regulated, like a public utility providing electricity or water, lower corporate taxes usually do get passed through to customers in the form of lower rates. Why? Because the regulators typically set the utility's prices based on allowing it to earn a specific fair rate of return on its assets after taxes. If the taxes go down, the regulator will likely force the utility to lower its prices to maintain that target rate of return.
Makes sense. But what about unregulated businesses where most of Berkshire's companies operate?
That's where the dynamic changes completely. In competitive, unregulated markets, companies with strong brands, unique products, or other competitive advantages often have significant pricing power. In these cases, Buffett argues, the benefits of a lower corporate tax rate tend to land squarely in the pockets of the owners, the shareholders, in the form of higher after-tax profits. They generally don't feel compelled to lower their prices just because their tax bill went down.
He uses the brain surgeon analogy to make this point really vividly, doesn't he?
Yes, it's a classic. He says, imagine the corporate tax rate is cut in half tomorrow. Do you suddenly expect the price of brain surgery or any other highly specialized in-demand service to drop by 50%? Of course not.
Right.
The same logic applies to powerful, unregulated businesses. If they have strong demand and pricing power, a reduction in their corporate tax rate simply increases their bottom line. It doesn't typically translate into lower prices for you, the consumer. The benefit accrues mostly to the owners.
Okay, and related to taxes, let's touch on capital gains specifically and why Berkshire actually prefers to buy entire companies outright, 100% ownership, rather than just taking large stakes.
The way capital gains taxes work was a big factor here. The 1986 Act increased the effective rate on long-term capital gains, which was unfavorable for Berkshire because so much of its value comes from the long-term appreciation of its major stock holdings. Think about its iconic investments in companies like Coca-Cola, American Express, or historically, Capital Cities, Jaito, The Washington Post. Holding these as partial stakes meant facing less favorable tax treatment on the eventual gains compared to pre-1986 rules.
So buying the whole company offered a tax advantage.
Yes. Various provisions in the tax code often make owning 100% of a subsidiary much more tax efficient than owning, say, 50% or 80% through publicly traded shares. When Berkshire buys a whole company, it can often manage the cash flows and intercompany transactions in a way that minimizes the overall tax burden much more effectively than just holding shares. This tax efficiency makes outright acquisition, when feasible and priced right, a strategically superior way for Berkshire to deploy capital and maximize long-term value for its shareholders compared to just buying minority stakes in the stock market.
And just a final quick point on share repurchases before we wrap up this section. What's his view on companies buying back their own stock?
Share repurchasing, or buybacks, is simply when a company uses its cash to buy its own shares from the open market, reducing the number of shares outstanding. It's generally seen as a signal that management believes the company's stock is currently undervalued.
Does Buffett agree?
He does, but with a very important caveat. He maintains a strict rule for Berkshire. He will only authorize repurchases of Berkshire's own stock if the shares are trading at a significant discount to their intrinsic value. He's very critical of companies that buy back their shares when the stock price is high or overvalued.
Why is that bad?
Because if you use company cash, which belongs to all shareholders, to buy back shares at an inflated price, you're actually destroying value for the remaining shareholders. You're overpaying. So buybacks are only good if done when the stock is genuinely cheap relative to its true worth. And finally, on taxes generally, while he always looks for tax-efficient strategies, Buffett often concludes on a pragmatic note. Paying more taxes is often just a natural consequence of making more money, and ultimately, that's a sign of success he's willing to accept. #outro.
Wow. That was an incredible deep dive. Reading through this collection of essays, especially the way Cunningham has structured them, it really does feel like getting a direct download from Buffett's brain. It offers such invaluable lessons, not just about finance, but really about clear thinking, ethics, sound decision-making, and that crucial long-term perspective. You really understand the why behind the financial choices.
It truly is a phenomenal resource for learning. We've seen how he applies these timeless principles, integrity, rationality, focusing on business fundamentals, to all sorts of complex issues like mergers, accounting games, assessing risk, always cutting through the noise to get to the underlying economic reality.
Okay, so now I've got a provocative thought for you, building on what we discussed back in Section 3.
Yeah.
Remember how Buffett pretty much dismissed gold, placing it firmly in Category 2, non-income producing assets because it lacks real substance, generates no cash flow, and its value depends entirely on someone else paying more for it later.
The greater fool theory reliance.
Exactly. So Given that deep skepticism about pure speculation, what emerging financial asset or maybe a modern speculative trend that wasn't around when most of these essays were written? What might he view with similar skepticism today? What might he classify squarely in that speculative category too? I can't help but think about things like, say, cryptocurrencies or maybe NFTs assets, whose value seems almost entirely driven by market sentiment and the hope of finding a future buyer, rather than any underlying ability to generate cash flow today.
That is a really interesting and relevant application of his framework, isn't it? It forces you to ask, have these new digital assets fundamentally changed the game, or have they just created a new form of scarcity, digital scarcity instead of physical scarcity, without changing that core speculative dynamic that Buffett finds so unattractive in assets like gold? A very relevant question for today.
Something to think about, for sure. Well, thank you so much for guiding us through this essential read. It was definitely rigorous, but incredibly rewarding.
Thank you. It was a pleasure. And to all of you listening, we definitely want to hear your thoughts. Based on everything we've discussed today, from the Essays of Warren Buffett, which one of Buffett's three main investment categories, remember, Category 1, currency-based like bonds, Category 2, non-income producing like gold, or Category 3, productive assets like businesses and farms, which one do you believe poses the greatest hidden risk to the average investor in today's economic climate, and why? Think about some of those subtle dangers we talked about, like inflation or hidden fees.
Yeah, we really want to know what you think. Let us know your answer. Please make sure to like this video, share it with anyone you think would find it interesting, and definitely subscribe to the BookMind channel for more deep dives like this one. And please comment down below with your detailed answer to that question. We look forward to reading your thoughts. We'll see you next time for another deep dive conversation.